This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you in part by
TheStreet.com, featuring Stephanie Link, who shares her investment strategies, stock picks, and market insights with Action Alerts Plus, the multi-million-dollar portfolio she manages with Jim Cramer. You can learn more at TheStreet.com/NBR.
On edge, the Dow closes out the week with a triple-digit loss as tensions over Ukraine rise and earnings disappoint. What should investors expect in the days and weeks ahead?
Anemic Amazon shares drop hard as investors take a closer look at its earnings outlook. What Wall Street is telling CEO Jeff Bezos. But is he listening?
And stuck in reverse. Ford's profits drop, so does its stock. What's behind the surprise miss, and can it get the engine revving again? We have all that and more tonight on Nightly Business Report for Friday, April 25th.
Good evening, everyone, and welcome. This was not the way anyone really wanted to end the week. After a generally positive earnings season so far, traders pull back hard today after big names like Ford Motors, Visa, and Amazon.com released earnings or outlooks that sent investors heading to the exits. Also adding to the sell-off mood, the simmering strife between Russia and the Ukraine as the U.S. warned of even tougher sanctions against Russia. Meanwhile, S&P downgraded Russia's credit rating to one notch above junk status. Stocks were able to bounce off the lows of the session, but the final numbers were not pretty and were enough to wipe out all of this week's prior gains. The Dow tumbled 140 points, the Nasdaq was down 72, a nearly 2% drop, and the S&P 500 lost 15. Dominic Chu now with a closer look at how all the saber rattling out of Russia is impacting markets here and around the globe, and what else is giving traders the jitters right now.
Stock markets around the world again came to the realization that geopolitical risks matter. Many traders point to what's happening in Ukraine and Russia as being a big driver behind Friday's sell-off. And even though Ukraine is thousands of miles away and has little to do with the U.S. economy, it still matters. Armed conflict anywhere around the world has a way of sending investors to the sidelines.
I worry about if Russia spills over to Europe, and Europe happens to be the second largest global economy in the world. So if the tension there starts to contagion effect into Europe, that's going to affect the U.S. companies that sell their goods and services there, and I think it's reason to be concerned, and we're watching it very, very closely.
But worries about escalating tensions between Ukraine and Russia are only part of the story. Another big driver for the stock market is still coming via earnings season. Just about half of the companies in the S&P 500 have reported their numbers, and the results have been generally positive. Over 2/3 of those companies have beaten Wall Street expectations. Remember, though, that those expectations had already been set very low this time around. It'll be another big week for earnings next week. Among the companies slated to report, social networking company Twitter, drug maker Merck, as well as oil and gas giant ExxonMobil. And a lot of experts still say that company fundamentals like earnings and sales still matter.
We're paying attention not just to the earnings that are being reported because there can be a lot of one-time issues that go into that, but also what the guidance is looking like, what the companies are saying about their underlying business. So if we can find companies that are reporting good numbers yet are still have good expectations for the rest of the year, that's a positive, and we want to focus on those areas.
Beyond just this next week, you'll still have companies like Disney, Whole Foods, and Tesla that will report later on in the season, as well as many of the major retail companies like Macy's and Walmart. So, it's too early to just sit back and relax just yet. Investors are keeping a close eye on global developments and, of course, that earnings picture. For Nightly Business Report, I'm Dominic Chu.
Well, those global developments are also being closely watched by our market monitor guest tonight. Barbara Marson is portfolio manager of the Gabelli Funds. So, Barbara, how concerned should investors be about this whole Ukraine situation? And what if there are new sanctions? How significant would that be?
I think it could be significant. You know, I'm surprised that we haven't seen more of a reaction. We have seen a little bit of stock market reaction, and of course the Russian stock market and the ruble have reacted, but really in things that usually price in risk around the world, such as higher yielding bonds or riskier assets. Sometimes you see the reaction in oil. We haven't really seen much reaction so far, and so I would say that's ahead of us, and I think it could be
gold up a little bit today.
Gold up a little bit.
Bonds, the yields came down, which indicates a sort of flight from risk.
A little bit could
and
be.
So forth. Taking that one off the table for now, earnings this quarter have been roughly flat,
yes,
up a little bit. There's an awful lot riding on better earnings in the current quarter and going forward, isn't there?
I would agree. You know, we had the last couple of years, certainly last year, earnings were up 5% year over year, and also the year before. So 2012-13, only 5% growth in earnings. So last year, all of the market appreciation came from multiple expansion.
It was speculative.
Right, and we can't really expect to get that this year. So we've been hoping for a stronger earnings period, and it really doesn't look like we're going to get it. If this year follows through on the first quarter, we're again going to see an approximately 5%
Does that make stock prices vulnerable in your view?
It does. It does. The market multiple going forward is about 15.2 times earnings, and that's a mediocre value if you're at full earnings. So we've been hoping that we would see an economic acceleration in the second half of this year, but I'm not sure. We've seen some broad-based housing momentum falling off. So.
Right. A lot of issues, the earnings, the economy, and global developments, but you still have a couple of stocks that you like, and I'm sure our viewers want to hear all about them. Halliburton is at the top of your list, and here's a stock that's actually done very well so far this year. Is it worth it to put fresh money into Halliburton?
Well, and I think there's a lot more to go. And Halliburton is a company that has strong growth in cash and earnings ahead of it over the next few years and is selling at a cheap valuation, which is, of course, what we want to invest in. Halliburton is a leader in pressure pumping, which is used in hydraulic fracturing, so it has very solid demand for its services over the next 3 or 4 years. And it's selling about, I think it closed today about $62 a share.
You're absolutely right.
And I think this year it's going to earn about $4 a share, but within the next few years that can be $6.57. If we put a 13 or 14 multiple on it, we can have an $85, $90 stock. So I think there's strong growth ahead of this company.
You like their stuff, you like their stock, Apple. Tell me this, though, Barbara. Should I want you to give me the case for Apple, but also tell me, should I buy it now ahead of the split? Or do I wait? Does it matter?
I would buy it right now. You know, yesterday's action, I think, showed how much pessimism there was. The stock was up 8% on 2.5 times the normal trading volume. And so I think you're seeing a reset. And then today, in a negative day, it held on to all of that and still closed up a little bit. So I would buy it now.
4%?
Yep, 4%. Very cheap stock.
Do you have a target price on Apple?
I think that once we get, it's selling about 12 times earnings, 9 times without the cash. So I think we're going to see an increased multiple when we get the big new product coming. And I think we'll see the old highs, which is over $700.
700. Okay.
Yes.
Real quickly, AIG. You like AIG, and this is a stock that's been flat for the year, around $50 range. Why do you like it?
Yes. Again, a very inexpensive stock, which I think can grow earnings dramatically over the next few years. Management is very motivated, very sophisticated company with some good growth drivers ahead. Company is selling about 75% of book value right now. That's book value is about $68 as of the end of the year. If that goes to about $80 in the next 2 or 3 years, we get a 1.2 multiple. I think you can have a $100 stock.
Disclosures? I assume you own all of these?
Yes, I own all 3 of these through my fund, which I own.
Okay, terrific. Thank you so much for coming by. Great having you on the program.
Great to be here.
Have a great weekend.
Thank you.
Barbara Marson, Portfolio Manager with Gabelli Funds.
Shares of Ford slamming on the brakes today, falling more than 3% after profits shifted lower last quarter, and the automaker warned of a leaner year ahead. Our Philibot has more.
An interesting day for investors in the Ford Motor Company as shares of the automaker were under pressure after the company reported first quarter earnings that fell shy of estimates by 6 cents. Now, there were a number of one-time charges that brought the earnings down by about $900 million. What Wall Street was focusing on was the underlying core business from Ford, and there's a mixed review there. Some are looking at the overall run rate in terms of the auto business over the next 3 quarters, and they're pretty optimistic about where Ford stands. But it's the mix, in other words, how many trucks versus cars that Ford was selling in the first quarter that got a little bit of attention. That mix was negative, and it has a few analysts wondering if Ford can reverse that by the end of this year. The CFO of Ford says that definitely will be happening.
We did have negative mix in the quarter that was around series mix and options and related to the products that were going to be running out as we move towards new models. For the full year, we think that will be fully offset by favorable product mix, so the types of products that we sell. So I think for the full year, that won't be an issue.
On the Ford earnings call, there were a number of questions from analysts and reporters about how long CEO Alan Mulally plans to stay at the automaker. Mulally repeatedly said that there's no change in his plans, although we should point out that there have been a number of reports that the board of Ford Motor Company is going to announce a succession plan within the next 30 days, and that Mulally will be leaving Ford by the end of the year. That's the story from here at the New York Stock Exchange. Phil LeBeau for Nightly Business Report.
Ford's losses were nothing compared to the sell-off in Amazon.com today. The stock got crushed, down nearly 10%, making it the biggest decliner in the S&P 500. And that's even though it posted quarterly earnings that were in line with expectations, as we told you last night. Josh Lipton explains what's troubling investors.
This is the original sign.
From the start, Jeff Bezos' strategy for Amazon has been to deliver big revenue growth, which the company then aggressively reinvests in the business. That's meant small profits, but it's a business strategy investors have embraced because they believe in Bezos' vision, building an e-commerce powerhouse that also offers almost everything, from tablets to cloud computing. Now, some investors are losing their patience with Bezos after Amazon once again delivered strong sales, but a disappointing profit outlook.
Amazon is now increasingly pushing out profitability. The market wants profitability sooner. It's not getting it from Amazon. It's getting the revenue at once, but not the profitability, hence the sale off in the stock.
Amazon's first quarter revenue jumped 23% to nearly $20 billion, driven by new customers and new products. But Amazon intends to keep spending a lot of money on hardware such as tablets and set-top boxes, as well as video content and delivery services. All that spending is having an impact on the bottom line. For the second quarter, Amazon projects an operating loss of up to $455 million. The stock dropped hard in today's trade, suffering its worst day in months. It's now one of the worst performers this year in the S&P 500, despite big gains in 2013. Bulls say Amazon remains near an important inflection point where the company will enjoy both revenue acceleration and margin expansion.
The market waxes and wanes on the desire, the need for Amazon to show profitability near term. My guess is that once again, somewhere later on this year, or maybe it's even as far away as next year, they'll get a little bit of a little more leeway in the market for profitability.
Amazon shareholders are having a rough 2014, and for the stock to get back on track, Amazon needs to prove that all that investment will lead to big growth and more market share gains. Josh Lipton, Nightly Business Report, Silicon Valley.
RJ Hadavi joins us now with his analysis on Amazon. He's Global Director of Consumer Equity Research out at Morningstar. RJ, great to see you again. What, if anything, is the market telling Jeff Bezos or saying about Amazon, and has it got the company right or not?
Yeah, I think that the market right now is clearly fixated on that profitability number. And really, I think it has lost a lot of patience at this point. I mean, the company has been growing explosively the last couple of years, and there's always been this promise of profitability behind it. And with the second quarter guidance looking for a loss between $455 million and effectively $55 million, that puts a dent and leads to a lot of questions whether or not this company can be profitable. But I think if you take a look at the numbers a little closer and look at the North America segment alone, which generated operating profits of 4.7%, that shows what this business can be. A lot of the investments the company is making are in the international segment. And in my mind, there's no reason why the success the company's had in the U.S. business in North America can't be replicated internationally. I think there's a tremendous amount of demand for the services that Amazon offers, and there's a lot of preparation that needs to be built out before that demand is satisfied. And I think that's what we really will start to see in the years to come.
Yeah, RJ, you make a good point. I mean, Amazon has amazing products. Hundreds of thousands of people are using the service every single day. But having said that, do you think that Jeff Bezos has to change something that he's doing here?
Yeah, I think he does a little bit, but I think we also saw part of that this past quarter. I think that the company's signal that it's looking a little bit closer at profitability was the increase in Prime memberships. The company raised its annual Prime membership fee from $79 to $99, and I think if you take a look at the incremental profit that comes from that, I think that's a signal that the company is a little bit closer focused on profitability across its entire portfolio. And I think as we look, not only at Prime but also Amazon Web Services, the different things that can drive profit for this business, they're really just started to take hold. I think this last couple of years was really a land grab story for this company, and just locking in as many customers as you can. Now that you've got those customers locked in and giving them, frankly, a lot less reasons to shop anywhere else between Fire TV and Amazon Dash, I think you'll start to see the company monetize those market share and customer acquisition gains the last couple of years and start to build a margin expansion story into what's been one of the better growth revenue growth
Big sell-off in the stock today, RJ. Would you buy it at this price, or do you think it goes lower and there'll be a better entry point?
No, I think it's got some support at $300, and right now, to me, it's quite a bit of a discount to my $400 fair value estimate. $400, my fair value estimate assumes that only mid-teen revenue growth, but also operating margins just get into the mid-single-digit range over the next 5 years. It doesn't take a lot with the revenue that this company is generating, not a lot in terms of margin expansion for this really to generate a really strong free cash flow story, and I think that's been overlooked. I like it right now at current levels.
Yeah, I just want to follow up on that, RJ, because in your report you said fair value of $400, which you just said, buy it at $240, sell it at $620. Talk us through a little bit on that $620 sell number.
Yeah, so the way Morningstar looks at stocks is we bake a margin of safety around our intrinsic value. My fair value on Amazon is $400, and based on your level of safety and comfort with the free cash flow of the story going forward is what kind of level you feel comfortable with it. At $300, I feel pretty safely. It's a 4-star name, which in our terms is a buy, and I think that's the right time to start looking at this. $240 would be the trigger point for a strong buy for a name like this, where I think that the worst case scenario has been priced in, and we feel pretty comfortable that this is the absolute right time. I think $300 for most investors, risk tolerance, it's the right time to get in.
All right, RJ, thank you very much. Have a great weekend. RJ Hottovy, Morningstar analyst.
Still ahead on the program, with supply short and home prices rising, many people aren't buying and focusing instead on their own houses and spending big money to spruce things up.
Initial public stock offering of Alibaba, the internet behemoth known as China's Amazon.com and Google combined, could be the biggest IPO ever. The Wall Street Journal says interest in owning a piece of the e-commerce site is so high, bankers say it could push the amount of money raised to more than $20 billion, possibly eclipsing the record $22 billion in the Agricultural Bank of China's IPO back in 2010.
Colgate-Palmolive reported a 16% drop in profits, and that's where we begin tonight's market focus. The consumer products maker was forced to take a charge because of a fall in the value of Venezuela's currency. Latin America is Colgate's biggest market in terms of sales. Still, earnings and revenue matched Wall Street estimates. Colgate shares fell slightly to $66.24. Burger King served up a higher first-quarter profit, but revenues came in lower than analysts' estimates. New restaurant openings overseas and cost-cutting efforts helped the chain to offset weak sales in the U.S. Shares rose more than 2% to $26.35. And Netflix signed a deal with 3 cable companies to bring its service to set-top boxes. Its streaming video will, for the first time, be integrated into TiVo's devices for customers of 3 small U.S. cable operators. You still have to subscribe to Netflix, but those customers won't need a streaming device to watch Netflix. Shares tumbled 6%, despite the deal closing at $322 and change.
And Kellogg announced plans to hike its quarterly dividend by 6.5% later this year. Separately, it named its CEO, John Bryant, as its new chairman. He replaces former CEO James Janess in that role. Janess will remain on the board as a non-executive director. We will find out more about the food company next week when it is expected to report its earnings. Shares were up a fraction to 66.71. VF Corporation saw its first quarter earnings climb 10%. The apparel maker saw double-digit sales growth in its outdoor unit. No surprise there. North Face is one of its big brands. So is Nautica. Also upped its full-year earnings outlook, VF did. That sent shares up more than 2% to 61.44. Whirlpool's first quarter sales were higher, but earnings came in well below forecasts. Currency and other headwinds in Latin America and Asia offset modest sales increases in North America and Europe. The appliance maker also blamed brutal winter weather in the U.S. for keeping customers out of showrooms and for disrupting shipments. Shares were up a fraction today, nonetheless, to 155.42.
A real setback in the housing recovery, and you can blame it on rising prices and higher interest rates. A housing industry newsletter reports mortgage lending fell to the lowest level in 14 years as homeowners cut back on refinancings and applications for new loans from potential home buyers.
And the head of Freddie Mac warns that a Senate bill aimed at shutting down the government-run mortgage financier and its sister company Fannie Mae could pose a risk to the stability of the mortgage market. Freddie Mac CEO Donald Layton alerted lawmakers that giving the private lending market a bigger role right away before the companies are eventually phased out would undermine the important roles, in his view, that Fannie and Freddie play in guaranteeing 60% of the nation's home loans.
Now, if you've been looking to buy a bigger home or to downsize to a smaller one, you're probably finding there isn't much out there on the market. So it's no wonder many home buyers are now thinking about remodeling their own home instead of buying a new one. Diana Olick has more on the big push to renovate.
Sit down and do your homework. The Riley family is rethinking the way they live. With one child already in college and another leaving in the fall, you might think they'd be looking to downsize, but it's just the opposite, because they expect the kids to move back in.
For them to come back here, they're going to spend thousands of dollars a month on rent. So the idea was to build a suite downstairs for them to have their own space when they came back home, and we had our own space on a separate floor.
Like so many others, frustrated by higher home prices and limited supply, the Rileys are choosing to renovate.
The big trend is that people are redoing their house instead of moving. We've seen a big spike in business, especially in this first quarter. There seems to be a good amount of pent-up energy on the remodel side.
Remodeling has been surging in the past year as people regain both home equity and confidence in the housing market. They are still, however, slightly gun-shy.
You're still very nervous about, overbuilding your neighborhood, putting more money in your house than you can get back if you're going to sell it. So we're seeing, for example, not $125,000 kitchen remodels, but $30,000, $40,000, $50,000 kitchen remodels.
Architects reported a jump in most sectors of remodeling in 2013, with additions and kitchen and bath remodels leading the surge. Only projects by first-time homebuyers were weaker as prices of both homes and redos rose.
There's been kind of a labor shortage in our market, and the builders are very aware, not just in flooring, but in all trades. So they understand that we have to bump up our labor rates to get all of our products installed.
Remodeling did slow during this rough winter, so contractors are expecting a surge in pent-up demand during the spring and summer, but then it should level off again in the fall as the housing recovery appears to be losing some momentum. For Nightly Business Report, I'm Diana Olick in Washington.
And coming up, Instagram isn't yet turning a profit for its owner, Facebook, but that's not stopping some users from making money, a lot of it. That story next.
The push to unionize is spreading at JetBlue. More than 4,000 flight attendants are lobbying to hold a vote on whether or not to unionize. They're working with the Transport Workers Union of America after a similar drive last year fell short of the necessary number of yeses to force a vote. Earlier this week, JetBlue's pilots voted to become the first group at the carrier to unionize.
Finally tonight, a look at how some young millennials with an outsized influence on a lot of social media customers are actually getting paid by brands to post photos and comments on Instagram, touting their products and services. And it turns out being Insta-famous or having thousands of followers on the social media website can be a pretty good living. Courtney Reagan has more.
2 years ago, if you would have told me, oh, some of your favorite brands and stores, you're actually going to they're going to choose you to be the face of an event or, for an advertorial in a magazine, I would have been like, okay, sure.
Once my following kind of passed 400,000, it was a little crazy because brands wanted to pay me good money to mention them and to do what I do naturally.
Justin Livingston and Danielle Bernstein are considered influencers, sought-after bloggers, paid enough by brands for mentions and photos on social media to make it their full-time jobs. A job that can pay between $60,000 and $225,000 per year.
When you have a person with 2 million Instagram followers, that's direct consumer advertising. It's a no-brainer.
Once the idea is set with the client, then we go hire out of this pool of Instagrammers in which they're taking photographs and they're talking about the campaign in the caption.
It's cheaper, it's social, but is it sneaky?
When I do giveaways, those are clearly advertising for the brand.
I think that readers aren't naive. They know that for a lot of the bloggers that have found success, that this is something that is a business now.
So they typically are disclosing by thanking the client or saying they're excited to be working with the client. Other times,
And that's enough.
And that's enough, sure. Other times you can add a hashtag sponsored or commissioned.
Would it bother you to know that some people are being paid or compensated in some way to post an Instagram picture wearing their new pair of Nikes?
Yeah, it doesn't bother me.
That's not really what Instagram is for.
Good for them. I kind of envy them, actually. If they're getting paid to show off a cool pair of shoes on Instagram, I wish I could do that.
The influencers say it has to feel authentic.
I stay really true to myself, and I won't just work with a brand because they want to pay me.
I don't ever want to feel like I'm shucking some product like a Snuggie. You know, it's like my reader's going to be like, wait a second.
There's an entire ecosystem making money off Instagram. Anyone, it seems, but Instagram itself. For Nightly Business Report, I'm Courtney Reagan in New York.
Let's take a selfie here, Susie. I don't even know how to do this, but let's take one. Say goodnight, Susie.
And good night, Tyler, and I hope we have 2 million followers.
That'll do it for tonight's Nightly Business Report. I'm not Susie Garib. I'm Tyler Matheson. Thanks for watching. We'll see you Monday.
I'm Susie Garib with the Nightly Business Report News Brief. A huge stock sell-off on Wall Street today following disappointing earnings from big names like Ford Motor. Ford shares tumbled 3%. But that was nothing compared to the sell-off in Amazon. It plunged 10%. Adding to investor worries, new tensions between Russia and Ukraine and a downgrade of Russia's credit rating to near junk status by S&P. The Dow lost 140 points, the Nasdaq down 72. That's a drop of nearly 2%. And the S&P dropped 15 points. Mortgage lending fell to the lowest level in 14 years during the first quarter of 2014. And here's something you don't hear too often. The U.S. has been called a rising star in a new ranking of competitiveness of the world's top manufacturing countries. Be sure to tune into Nightly Business Report right here on your public television station.